Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice. In episode 2, Bill Harris and Bryden Teich discuss how global stock markets are currently being impacted by central bank liquidity and relate that to previous periods of market exuberance. They also discuss the signal that the underlying economy is sending at the outset of 2020, and they discuss the outlook for the Canadian energy sector.
So if we were to start off, one of the things I think that has been happening the last number of months is now the Fed has been expanding their balance sheet, and you've seen global stock markets really since September really take off. And it feels like we're in now a momentum and a liquidity driven market. And there's no telling how long that can go for, but what's your view and feeling of being in the stock market for 30 years, what this last 4 months has been like in terms of liquidity and momentum?
Yeah, that's one of our main conversations that we have each day. And it's seeing how much liquidity was created halfway through last year. And it's just extraordinary, the number as we're rolling through the cycle. And then always going back in other markets. And certainly when you have a shock to the system and the market goes down dramatically in a short period of time, everything will all move together. And it's usually for a short period of time. But what we've seen over the last 2 years with 2018, where almost everything was down, and then with one central bank, the U.S. Federal Reserve Bank, changing policy mid-year in 2019, with the market anticipating it ahead of time, and then almost everything went up. So getting the Fed right really is almost the most important thing to do at the moment. And so, but it's trying not to predict, now we're going to take a contrary bet and say we're going to bet against it. That's it. It's too high. It's all going to fall.
Right.
When it's happening, and the Fed is committed to easy money, certainly through this year, almost sitting on their hands through the election cycle. It is happening. You've just got to go with it.
Yeah, I think the one thing also on that point is that now that you're in an election cycle, and the Fed almost has kind of boxed themselves in, because we're in this sort of unprecedented world where the Fed is now being politicized regularly in an election cycle. And regardless of what the economic data does or doesn't do, they kind of at all costs don't want to make a big decision that could be interpreted politically. But at the same time, if the underlying economy either gets really or a lot better or gets a lot softer, they kind of still have to do their job and be reacting to that. And so I think, how do you see that Fed decision now out for the rest of the year? Do you think that they're going to be on hold, or do you think that, they might be politicized in any kind of a way?
Yeah, certainly they're trying to get out of the politics. And I think what's nice about it is, we like talking about this and thinking about it and reading about it, but really our job is here, and the strategy is go where the valuations are. So we've already established that the market is going, it's running. We are not trying to outguess or, outsmart ourselves. Now the question is always, where do we see the value, and where can we get the income that we're looking for? And so just make all those assumptions. This is true, and now bring it back to what are we going to do about it? Where are we going to find value? And really always coming from the point of view is, where do we protect ourselves?
Right.
How do we, analyze what is the downside first, and then make sure as we're going through this year, if things get too expensive, recycle it back into something that's not expensive.
Right. I think the other thing too is that with what central banks have done the last decade now, with interest rates being so low in both nominal terms, but also real terms, if you include inflation, you're basically at a point where the returns on cash and the returns on bonds of multiple durations are now basically the same. And so this idea of, money that has been on the side has been forced into owning assets, whether that's art or farmland or real estate or stocks or, global stocks. And so this idea now of being in a zero real interest rate world, anything can kind of be really funky very quickly, where Tesla goes up 100%, just because at a zero real interest rate, everything's worth whatever you want it to be, or whatever that last person was willing to pay for it. But I think going back to this idea of what the Fed has done, and if you look at the money supply, so M2 aggregates have really shot up in the last 6 months, but at the same time, it doesn't seem like that money is making its way into the real economy. And so you're in this window, having a momentum market, having all this extra liquidity, having money supply having increased significantly, but it's not making its way into the real economy, which then means you're in an environment where anything can kind of happen from a stock perspective.
Yeah, it's an extraordinary point in time. So, I mean, we throw around these, sort of jargony terms about monetary policy, and it's one of these things you sort of study in university for a couple of days, and then you really sort of forget about it, and it doesn't really affect most people's lives until right now. Right. It's so extraordinary, and we talk about liquidity, which means just cash into the system. But there's nothing we really need to do with the cash at the moment. We have as many auto plants as we need.
This overcapacity that's kind of happened is now...
In the tangible world, there's overcapacity. And in the new economy, the digital economy, we talked about this in the 2 quarters ago, the newsletter, that the old economy has these super low interest rates. The new digital economy doesn't borrow money. I mean, it doesn't, we've got a Google office tower going in right across there. So there's tangible office, with people in it, but they don't build things. Like if you want to repeat your software, you just hit a button and you reproduce it. So it's an extraordinary change in the economy and so if you're going to print more money, the only place it goes is into financial assets. So whether that's your house or you mentioned art, and also just hitting on the point, it's the size of the bond market and the size of the bond market globally, it's just a huge tank of money historically.
10, 15 trillion.
That just sits there. And that was the bulk of the return for institutions, pension funds, insurance companies. And now, as you rightly pointed out, the interest rate, no interest rates, and making it equivalent to cash, all that money is under incredible pressure to go somewhere. And now we're seeing booms in private equity, venture capital. We listed this other one, the U.S. corporate bond market. And so what's important for us is it's coming back and saying, well, we have an equity strategy where we have ownership in businesses where we try to capture the income stream. And now getting really nervous, are those getting expensive? And so really our discipline is coming back and saying, okay, we know there is this bubble in cash happening. How do we still protect ourselves, capture our income stream and protect ourselves?
Yeah, no, I think the other thing too, like adding on to that is just the one specific thing that's happened in the last decade since 2009 is you've had this huge boom into indexing too. So ETFs, whether it's stocks or bonds or kind of liquid bonds that can now be traded liquidly. But the one thing that we've talked about this a number of times in the office, but this idea of, let's look at technology specifically. And this idea of, if you look at all of the major global technology firms, they're all in the US, and any global money that is in any kind of equity strategy that needs technology or wants to invest in technology, whether it's a public company, whether it's venture capital or private equity, all of that money is getting funneled through this technology boom in Silicon Valley and some of the other tech hubs throughout the US. And so maybe talk to that point a little bit of the concentration of not just having all this money in bonds that needs a rate of return, but then you've only got a handful of technology companies or private equity funds to put that into, and you've had this huge move into these assets because of that's the place to have been.
Well, so we touched on this argument the other day, and I also want to come back to just straight valuation on take the broad index in the U.S., like the S&P 500. Where's the valuation at? And actually, the reality is the valuation is fair. It's just a handful of companies out of the S&P 500. 50 of them have these extreme valuations, and the rest of them are actually relatively fairly valued. So anyway, the way we were setting up this premise and going back again, 30 years ago when I was interning in the business and saying, if you ran a German pension fund, or I was in the UK with a group that was running pension funds there, and every portfolio sort of looked the same. You have a bank and a utility, and you have a telecom company, and Germany had their 3, and the UK had their 3, and then if you were in New York, you had AT&T, you had Wells Fargo, and then Canada, you had our bank, telecom, utility. But now when you say, oh, what's the greatest hottest thing in computing, and that's cloud computing, there's only 3 companies on the planet. And so it's the scale of that everybody from Dubai to Hong Kong to Frankfurt to London, every single money manager in the world that wants cloud computing exposure has to go to the same 3 stocks. And magically, Microsoft is 1.2 trillion market cap. And just coming back to that one point, 10 years ago, Exxon was the largest company in the history of capitalism at 400 billion. And now Microsoft is 1.2 trillion, making $40 billion a year in earnings.
Yeah, and Apple I think is 1.3, and I think Google is now 1.1 as well. And so you can see this technology boom that's happened, and layer over on top of that indexing. And it's not that these companies aren't doing fantastic things or making great technology advancements, but it's just you've had this huge rush into anything that is a super high weight in any major index, and you've just had these valuations sort of take off to nosebleed levels. And I think our view is always coming back to saying, where can we actually go in and find value and consistency? And it's not to say that some of these companies aren't great companies, but the idea is always, how much are you paying for that asset? And if you're going to be an investor for 10 or 20 years, you have to really think about not just what you're paying for in terms of where the stock is, but the actual value, and on a go-forward basis, can you get your rate of return in something that's trading at a 1.5 trillion market cap? Well,
this is what we wrote in the last quarterly report and tried to, the phrasing is saying the degree of confidence. Right. So if Microsoft, and maybe we'll just touch on that, for a second. So if Microsoft is trading over 30 times earnings, and we want to double, our principle is, can we double our money as safely and conservatively as possible? Microsoft, by that definition, which really doesn't pay a big dividend now, has to double. It has to get to 2.4 to 2.5 trillion market cap in the next 10 years, which is then, as we said, is the size of Canada.
Yeah.
In one company. And so the earnings has to go from 40 billion to 80 billion. But then that implies with the multiple, this is one of the hardest things about stock market math, is the market multiple. So for the stock price to double, the multiple still has to be the same, 30 times 80 billion, implying that Microsoft has doubled in size and is still growing at just as fast a rate as it is today. Or it trades, you would make the assumption that the growth is going to slow a bit, so it's trading at a multiple of 20 times earnings. So for the stock to double, it means earnings have to go from 40 to 120 billion. It's possible, but you're asking a lot. And then the way we phrased it, it's never happened in human history before. So you're predicating, saying, here's my bet. I'm going to say that I have a great deal of confidence that Microsoft is going to do something that has never happened before. Or when we come back to our portfolio of saying, can we find really highly profitable, consistent businesses that are trading at 10 times earnings and give us an income stream, we can double our money with way less risk,
right,
going with a whole other group of businesses.
And to your point, it's a whole higher degree of confidence in what we're doing.
Yeah, what is the downside risk?
Yeah.
What is the downside risk, and can we do this and have confidence that? And we talk a lot about this. Events happen over the weekend, and trying to communicate with clients as clearly as possible. Just like, well, what are you worried about the stock market? Just like, well, we're worried about a lot of things, but we're really comfortable with the businesses that we own, right, because we know we don't have high valuations. But that's the hardest thing to communicate all the time, because we do the work all the time on what we own and why we own it, but just making sure we're communicating that as best we can.
Right. So I think if we were to just switch gears a little bit, one of the things I think you and I often talk about, it's been obviously in the news the last year, has been this sort of ongoing trade war between the U.S. and China. We kind of got this phase one deal in December, and it looks like, at least for the time being into the election, there's probably not going to be a ratcheting up, but you never know. But I mean, from your view and from some of the things that you're looking at, what do you feel the state of the underlying economy is in both Canada and the U.S.? And I know often people conflate the stock market and economy, and actually they're quite different things. And so the stock market can be doing one thing while the economy is doing something totally different. And so what's your feel for what the underlying economy is now, if you think of both manufacturing and on the service side, with in light of having run a trade war now for over a year and a half?
Right. So it seems like the trade war effect is in the numbers. Like, we've really had a slowdown in the industrial economy, but we come back to the point in a place like the U.S., our North American economy, manufacturing is in that 14-15% range, might even be slightly less than that.
Yeah.
It is definitely affected, and it is the middle of America that is, we would argue, by last summer was in recession. Right. And we actually think they're coming out of recession, and this is where we've made a few investments in that area where we feel there's stable businesses that have been really beaten up in the stock market, and the businesses are just fine. And so we would, whether it's stable or hopefully recovering a bit, but there is numbers, and we were looking at it this week, of saying this slowdown on the global economy actually might be rolling out.
Right.
And so again, we just don't want to get ahead of ourselves, because the stock market really seems like it's on fire at the moment, and just not to get caught, because really the economy is quite slow. But the most important thing is this word we keep using of liquidity. There's way too much money in the system, and that's driving everything.
Right. Yeah. No, I think the one thing that I find interesting is that you've had this kind of rolling effect of if you look at CEO confidence, a year and a half ago really started rolling over, sort of right in the middle of the trade war issues between U.S. and China. And so CEO confidence got weak, but then it took 6 months for the manufacturing data to start getting soft, but then that rolled over. And then at the same time, you've had, if you look at the S&P 500, yes, earnings look good because you did a major tax cut and everyone's buying back their own stock. But if you look at the underlying aggregate profits in the U.S., like your private individual businesses, all profits in aggregate have rolled over. So your profits have now started to get hit. And so the next thing to happen, though, is that traditionally companies try to protect their margins. And so their profitability is obviously important. So then you start cutting back on labor. But that shoe hasn't fallen yet because consumer confidence is still high. Employment rate is still incredibly low. But it feels like if there were to be that next shoe to drop, that would be where it is. And I think the next 6 months of employment data becomes very, very critically important, because once the consumer gets that sniff of, oh yeah, I might get laid off, or my neighbor got laid off, and I'm just going to pull back on my consumer expectations, then you could really get into a recession, because at 1.5%, 2% growth, it doesn't take much for things to really roll over here. And that's what I think, going back to originally how we started this, is that what do central banks do if you do get into that kind of period where you have a couple of negative quarters of GDP growth, because they're already basically at zero?
Oh yeah, you've hit a lot of topics there. Yeah, no, and introduce them all. And maybe I'll refine it, saying that it really is about the employment numbers this year. Yeah. And in terms of the overall earnings, North America, and then using the S&P earnings, they're actually unbelievably stable the last couple of years. But that's hidden by the fact that the top 50 companies are going gangbusters. And then we have this, if we're talking about a deterioration, it's in the other part of the stock market. And so watching that, certainly that's the hard data on the economy. And then on soft stock market indicators, really looking at market sentiment going forward, and where we were incredibly low, like this time last year, and there was this idea that we were going into recession, at least in some point in the next 6 months. And our argument was, that's fine, but we're already there. It's already in terms of sentiment in the numbers. Yeah, we were at 45, using jargon or technical terms, 45% of market participants were positive. Yeah. That market doesn't go down. There's nobody to sell it to. Like, everybody's already negative. And so where we will start to get negative, as we're going through this last 3-4 month period, sentiment is going up gradually. Start to get nervous around 70, absolutely at 80%, but we're not there. In which case everybody's bought, and then this is where you have to get nervous. Yeah. But the other one, which we looked at this week, which was extraordinary, is stocks trading above their 200-day moving average. It's a technical term. We're not basing our decisions on technicals, but just noticing that these are one of those outlier things that only happens occasionally. But it shows, in terms of long-term trends for stocks over the course of a year and a half, almost every company is in an uptrend, and that is highly unusual, and also something to make you nervous about, which comes back to the valuation. We want to make sure that we are being, as defensive as we can be now, whereas within our strategy, we were making sure we were absolutely all in this time last year when everybody's negative. Yeah. Now that everybody seems to be positive, we want to be, bringing in an element of caution. Yeah. No, I think the thing too on those two indicators, both if you look at bullish and bearish sentiment, and then also percent above 200-day, is that they're both in that flashing yellow stage now, where it's not full stop, okay, you got to get really defensive, but it's also not, okay, this is actually way too negative, you got to get really aggressive here. And you're kind of in that neutral zone, but it feels like you could have a thrust higher here if you have a strong first few months of the year, which then I think would be, for long-term investors, signaling a little bit of caution of saying, what, prices are high and sentiment is very, very positive. Generally, that's pretty good time to be thinking of raising some cash or creating some money for
future opportunities from that perspective?
Yeah, we went through all our businesses this week on Wednesday, and it'd say nothing has rolled over, just in terms of price chart. And if they haven't, you just sort of say, if it hasn't rolled over, you can't say that, okay, we've had a correction, because everything is still in a strong uptrend. And we're in a presidential election year, and usually that's sort of a neutral, sometimes slightly positive year. But Trump effect, and say not making a political call, this is purely a stock market call, he's sort of messed up the whole cycle of trying to use sort of a standard gauge,
traditional timing of it.
Timing. And then traditional timing is really, you get a Christmas rally and relatively a light to upward market into April, and then you've got your sell in May and go away. That's sort of end of April to the beginning of the summer as a time that if you want to really just avoid the stock market, that would be the standard thing we're looking for. So you would still get a push up in the next 2-3 months, and then you want to sit on your hands for a bit. But our stock market, seasonality seems to have been thrown out the window about 2 years ago.
Yeah, no, totally agree on that. I think the one thing too is, I would be remiss if I didn't ask you this, but you were out in Calgary last week, and so having met with a lot of companies, and you go out to Calgary for a particular conference at the beginning of every January, and what would be, being boots on the ground, having the time to meet with all these Canadian energy companies, what would you say is the sentiment like from both a investor perspective, and then also maybe some of the things that some of the companies were relaying in some of those meetings?
Right, and let's just even go through first what we did. So it's coming back to August, September, where these are extraordinary low valuations, and going back to, it was 1998 in the Asia crisis and the Russian bankruptcy that we had valuations like that. It had to go back that far to find a period that was similar to it. And so we went as overweight we could be within the sector, and then we've had a nice little move, and we've actually gone back to what we would call a neutral weight in energy, and sort of saying, okay, we have it, the companies are making money at this commodity price. If we come in and say, is my business a good business? Is it making money? And have I not paid too much for it? And it ticks all those boxes. And then you say, what's market sentiment towards it? And it's still ambivalent.
Terrible.
Yeah, it's just I don't care.
Yeah.
Where's that next dollar going to come in? So you're sitting in the conference room and asking the questions, well, are you getting calls from New York? Are you getting calls from London? And the answer is no. There's no calls. There's no incremental dollar coming into Western Canada to invest. We still have this big stigma that Canada, you can't get anything done. So we have to be really cautious. We're looking at our investments of saying, can we clip our income off of these? And I don't care if nobody shows up ever.
Right. So you're getting paid at this low valuation to just sit there as you're still owning a profitable company, waiting for things to get better.
Yeah. So more time has to go by.
Yeah.
So either we fix, we fix our infrastructure issues, or something else happens. That energy is such a compelling investment that people have to come back to it because they're making so much money.
Yeah.
But it doesn't seem like we're there at the moment.
But sentiment from some of the companies you spoke to all seem like they're still profitable at these levels. They're moving ahead with their particular growth projects that each company has. And was there would you say high attendance at this conference based on previous years? And so it seems like that.
Yeah, it was busy.
Generalist investor is coming back, whereas 3 years ago it was you could throw a bowling ball through the conference kind of a thing.
Yeah, that's absolutely right. Yeah, they were big, Toronto institutions. Absolutely, the Calgary group of participants. Everybody was there. Everybody was very keen. About 50 companies in 2 days, and they said it is busy. Western Canada is throwing off 4.5 million barrels a day. They're doing it incredibly efficiently, except it's not dynamic. Ironically, getting to where we are now is incredibly unproductive because so much money got thrown at it so fast. Importing people from everywhere to get stuff built. That is a recipe for terrible productivity.
Right.
Now everybody's complaining I can't get anything done, but there's incredible productivity means dollar for labor unit added. It's an incredibly profitable, productive sector, and everybody's ignoring it.
You mean versus going back 10, 15 years ago where this kind of anecdotal boom in Alberta, and it was welders were getting paid, $250,000 a year because
there was just drivers in the oil sands making $200,000.
Right. So the where that kind of a frothy economic environment sucks so much costs out of the projects because you have to pay labor so much, you have to pay your transportation. But you're saying now that cost of labor, that cost has come off, these companies now are just so much more profitable because you don't have that same shortage of labor.
And you've gone from increasing from 2 million barrels a day to 4.5 million
Right.
barrels a day, but now you're doing it with a handful of people doing it really efficiently.
Right. Do you think the other thing, just touching on it, is that it seems like some of the things that I've read in the last couple of weeks, that where last year at this time it was supposed to be a very cold winter, you had this kind of record cold across the Midwest prairies, both Canada and the U.S. So obviously natural gas prices were pretty strong. As we enter the beginning of last year, it feels like now you've kind of got this glut environment where the winter so far hasn't been as cold as expected, and inventories have been kind of built up. And do you have a view on the gas market, North America in general, just based on what prices have been doing the last couple of weeks?
Yeah, it's a really tough one. So it's North American gas and really NYMEX, and it looks like there's too much gas in the U.S. for the first time. There's not that there's excess gas, but they've been able to have a relatively healthy $2.5, $3 U.S. gas price, and that's really come off. Ironically, and our one of main gas investments in Western Canada, they've fixed a lot of the infrastructure and how the gas gets around, and so we're actually getting a much better price.
Right, and that would be AECO pricing.
AECO, yeah,
right.
Alberta pricing, and then there are actually all sorts of things being built now, whether the potential of LNG, but chemical plants and things like that. There's uses for gas in Western Canada, and they've fixed the infrastructure bottleneck. It's still not a great price. As I said, we've got one bullet that we've spent there. It's got a big income and it's making money, but still watching that really closely.
Right. Is there anything else you want to talk about?
I think I just touch on this. If we're going to go into this, maybe this is another show where we even chop this one up.
Yeah, we can do it.
Yeah. But that Bill C-69. This is the big test for Canadian infrastructure, and really how Canada sits on the global map. The main one that's in the newspaper is Teck Resources doing the
Frontier
project.
Yeah.
Big thing for the oil sands, just say another project can go ahead. Big thing for Teck, big thing for Alberta to sort of say, okay, if you put the TMX pipeline in, this is the one from the oil sands to Burnaby, BC, there will be room for another project with capacity. You're over capacity now, right? Roughly around 200,000 barrels have to go by rail at the moment. But if you put in just TMX, and then Enbridge has what's called their Line 3 project, and then there's lots of capacity, and you could actually bring on a new oil sands project.
Wow.
So,
so if production's got up to 4.5, with, let's just say, fingers crossed, TMX goes through and Line 3 goes through, what does that 4.5 go to? 5.5, 6? Does it go to 5? What is that?
Yeah.
That
so,
number.
So the expectations of rough projects that are on the books, but it's so expensive to build a new oil sands from scratch.
And let alone ESG.
Yeah.
That kind of
stuff. Right. So the whole world might change ahead, and really, this is what it comes down to: is that there are projects on the book to go to 6 million barrels a day, but then they have to get approved. And Bill C-69 says the federal government has to approve big resource projects, from the environmental side, and then let's go see if this happens. So right now, the Premier Kenney is already gone to Ottawa and said, we're doing this because this is what's important to us. So it's going to be a big test if something can get built. But the fascinating one that came up in meetings last week, and I don't think we're saying anything that's not, it was a publicly disclosed meeting, but Suncor is describing that it takes so long to permit a project, really in the course of 10 years, is that one of their original mines is going to start rolling off in 2035. So you'd say, well, that's a long way out. But they are going to start permitting it now because they know it takes so long to do it. And so you've got all your plant. When you look at the oil sands, there's two things. You look at the mine and the mining activity, where they're digging it out, but you have all these, the tanks and the pipes and all that stuff, the processing plant. So you've already built it. A lot of the capital is in the processing plant. So the mine just feeds the raw material into the processing plant.
Which is already built.
But it's already built. So what they're doing is this mine has been mined out, and we'd like to start at this other mine to feed the same plant. Suncor would say, I'm just keeping my production flat. But I could probably go and get a new permit because I'm talking about 2 billion barrels of oil. So they're going to go into the permitting process, the C-69 permitting process, and say, can they go to Ottawa and get a permit to keep their production flat, but then the Liberal government has to make a decision on the oil sands being in business in 2035,
right. So
and they're going to wear that.
Right, and it's almost like a litmus test of saying, do you actually want to get any projects done ever
in
Canada?
Yeah, it's going to be absolutely fascinating.
But it doesn't actually affect Suncor because it's such a long duration asset, long dated asset, where it's not going to affect anything they're doing for the next decade even. It's just saying, we know we have to do this in 15 years, and we're going to test you to see if you actually will allow us, which is, Suncor is a fantastically run company, great on all sides from both management, operations, safety, your stalwart Canadian energy company. If they can't get something done on this size, keeping production basically flat, it's basically saying nothing's getting done.
Yeah, so from a stock, I would imagine from a Suncor point of view, we don't own Suncor. We have in the past. We don't own it right now. And we said slightly higher valuation than where the other producers are trading. But really, it's not going to affect Suncor as much as it's the overall tone in the whole industry. And is Canada investable? And this, between Teck and Suncor over the course of this year, you might come out the other end just saying, Canada is still dead to the world.
Right. So, I mean, if you go down the list of Canadian energy companies or look at the sector as a whole, you're going back to levels that you haven't seen since 98, 99, 2000, both on valuation and sentiment, and if you look at the S&P, for example, the weighting in energy has never been lower, and it's predates back to 98, 99, same issue. And so, being someone who's invested, was managing money back then, looking at the energy space, how does it feel today, or the last couple of years, versus what it was like, 20 years ago, 22 years ago, when you anecdotally would say, well, no one even wanted to look at any of these companies, even though it was 2 times cash flow or 1 times cash flow.
That was just right in the. So okay, that's actually a great analogy, because we've already said that this. A few commentators, and there's articles being written now, that the way the stock market is exploding in the senior, sort of digital economy stocks, that it's starting to feel an awful lot like 1999.
Yeah.
Going into 2000. So that's when that Asia crisis and currency and capital crisis happened in 1998. And then the oil and gas companies, the producers in Calgary, got down to 2 times cash flow. And they sat at 2 times cash flow for 6 months, while Nortel went to 100 times earnings.
Yeah.
It was supposed to make $1. I remember I sat in meetings, at the enterprise ship, boardroom table at TD, and we couldn't talk about anything else. And it was supposed to make it was made $1. It was supposed to go to $1.25, and it was trading at 100, and it peaked out at about 120 before it collapsed. It ended up being accounting fraud, and it didn't make any money at that time. Yeah. But going around the table, and the conversation never even got to me, where I'm just sitting there pounding the table saying, my stocks are trading at 2 times cash flow, not 100 times future fraud earnings.
Yeah.
And but that's full circle going right from there until the fall, where really we had high quality companies in September that were trading at 3 times cash flow.
Yeah. And
so we bounced from that, and we're in the 4 or 5 times range at a low base, but it's hard to figure out where that push is going to come from, of saying it's okay.
Yeah.
And I'll end on that. Yeah. There's still a feeling that 10 years from now, we might be regulated out of business, and that's the
right. Like the world is changing so quickly that that's the sort of added layer of complexity today versus back then, when it was none of these other things were even on the table.
Yeah, we even wrote this in one of the letters last year, which is the original oil sands analysis that, first time I did a spreadsheet, was that you had a cost of capital, you have to borrow money, you have to build plant and equipment, and then, but nowhere did you value air and water.
Right.
Air
now
and water is
they're priceless.
Now it's priceless. Yeah. So how do you, if suddenly you come in and just say, well, I can't even put a price on that, because you shouldn't be doing it, well, then you just shut the whole thing down.
Right.
Maybe we'll leave on that happy.
Yeah. Well, no, that was great. Thanks for the conversation.
Okay, right on.
Perfect.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.